first partner that we're going to discuss today is a loan officer. The loan officer will be the first partner that you're going to encounter when you have a client that's looking to purchase real estate property. So we're going to dive in a little bit about what, who, and what a loan officer is, what they do, and how they help you and your client through the process of purchasing a home. So, what is a loan officer? Well, a loan officer, per Wikipedia, is a loan officer is a representative of a bank, credit union, or another financial institution who assists borrowers in the application process. Loan officers are often called mortgage officers or mortgage loan officers because they lend loans for mortgages, right? So you're going to get your loan officer involved before you start showing your clients a home. That is the first person you're going to encounter when you have a client that's interested in purchasing. The first question you should be asking them is, great, have you talked to your local bank about purchasing a house or obtaining financing or getting a loan when you're buying a home? And the answer is no, I have not, because a lot of times that's the case. Most people purchasing a home didn't go through home buying 101, even in grad school or college, or let alone high school. So we need to help them along in this process. So the first thing that we're going to do, we're going to have them sit down with the loan officer. Now, the loan officer will ask them very personal information. A lot of times, a lot of agents do not sit in those meetings. Now, if they want you to sit in those meetings, you're welcome to, but they will be discussing a lot of private, personal, financial information. Okay. And what the first thing that they're going to be doing is they're going to discuss their income, their job history, their credit score. They're going to need all that information to get what we call a pre-approval. A pre-approval basically is a letter saying, from everything that the bank knows up to this point, we would be willing, not 100%, mind you, but we would be willing to lend them a certain dollar amount, depending on how much income they made, to purchase a property. And I always call this like a blank check, so to speak. Now, they will give you parameters. They'll say, we'll let you purchase a home up to a certain dollar amount, as long as everything stays the same. So if the client, your buyer, loses their job, we'll say, or make less money, or something happens to the credit, they borrow or buy a new car, that can affect this process. So you have to, the two key things in this process is this: whatever your loan officer needs from your buyer, they need to give it to them. If they do not do what the loan officer asks, then they will not obtain the loan. So even if it's their firstborn, sometimes they need to do that. So they need to be aware that whatever they need from them, please, they need to provide the loan officer. The second thing is, during the home buying process, do not make any changes to your life whatsoever. Don't go to Vegas and go on some spending spree. Don't buy a new car. Don't lose your job. Don't change jobs. Everything needs to stay consistent through the process. Okay. All right. That is very important through the process. Something I want to preface at the very beginning as we dive into the different types of loans that loan officers can provide is, I want to make sure you do not need to be an expert in the loan process. That is your loan officer's job. The information that we're going to be giving you is very high level. And these are going to be pros and cons of the different types of loans that you'll be encountering during your real estate career with buyers and the loans that they will be obtaining. So I want to make sure that you don't stress out about what the current interest rates are and things like that, because you don't need to know those. And honestly, they will change. Sometimes they change weekly and monthly, and it can be so confusing. And that's why you have a wonderful partners and a loan officer. Okay. So the loan officer is the first partner that you're going to encounter in this process of buying property. So there's two types of loans, unconventional and conventional. Unconventional and conventional. Okay, we're going to discuss conventional loans. There's pros and cons with each one, but we're going to go over those now at a very high level. Okay, so a conventional loan is basically a home loan that is not, again, NOT, not backed by the federal government. We're going to be talking about FHA loans and VA loans here shortly. I know a lot of people have heard of that terminology, even if you haven't been in real estate. They're wonderful loans. We'll get into that later, but there's pros and cons with each loan product. Okay. All right. Conventional loan mortgages. They basically have to meet certain criteria by these entities, these public entities called Fannie Mae and Freddie Mac. We're not going to talk about that today. If you want to know a little bit about them more, you can look those up and dive into it. All right. Now, any bank that you deal with your checking account or savings account, these banks have what's called conventional loans. And they'll have both conventional and unconventional most of the times. Okay. So a conventional loan is you usually have to put a little bit higher down payment down on these loans. And a lot of times, if you don't put 20% down or more, you'll have to pay for what's called PMI, or private mortgage insurance. Okay, I'll touch on PMI really quickly. PMI is an insurance policy that your buyer purchases on themselves in the event, if they default, that insurance claim will kick in to help cover the losses that a bank would incur if you default. It does not help your buyer at all. There's no benefit to the buyer at all for paying private mortgage insurance. Okay, your loan officer can dive more into it. They can dive into how much, what that will cost them every month if they cannot put 20% down on a house. Now, if you took your real estate exam, you understand what down payment is. That's a very basic part. But if you buy a house for $100,000, 20% down payment would be 20% of $100,000, which would be $20,000. If your client do not put 20% down or $20,000 down in this example, they would have what's called PMI. All right. But again, they can discuss that with their loan officer. All right. Conventional loans, a way that I teach agents over the years for them to remember it. Conventional loans are the way it's normally been done for years. You used to go to a bank in the old days and ask them to borrow some money to purchase a farm, for example. The bank would go back in their vault, scrape out some money, and hand you the money to buy that farm. It was very conventional. It's more complex now, but that's the basics. Okay, that process of banking has been around for hundreds of years. Now, let's move into the second type of loan called unconventional. Unconventional is just like it sounds. It's unconventional. It's not how we normally done it. Well, what's the difference? Well, the government, to encourage home ownership, the federal government said, hey, listen, I think it's important that everyone owns a home. And we're going to come out with these loans that require little to no down payment. And your credit score does not have to be very good, but you can still obtain a loan to buy a home. Banks said, no way, that doesn't make business sense. These would be very risky loans. So the government said, don't worry about it. These people can go to the local banks, take out an unconventional loan, and in the event that they would default on these loans, the government would step in and take that risk off their hands. That's basically what it means in layman's terms. Okay, there's three types of unconventional loans that are very popular depending on the area you live within the United States. One is called an FHA loan, or Federal Housing Administration loan. Second one is a VA loan, or Veterans Affairs loans. That'll be for our veterans, active duty or not. And the third is a USDA loan, or the U.S. Department of Agriculture. Those types of loans are for people who live in more rural parts of Ohio. This is not loans that people take to buy farms. This is basically a loan that was created to get people out of suburbia America to move to rural parts of the country, you know, to entice them to do that. This is not loans that they would get to if they wanted to be a farmer. Okay. Now, all federally backed mortgage loans are special in many cases, and they usually have very lax lending guidelines. And we're going to talk about the pros and cons here in a second. Okay. Now, with a conventional loan, there's pros and cons with everything in life, right? So let's talk about the conventional loan. The pros with conventional loan is they have great rates. Okay. Because remember, more money you put down on a loan, less risk that would be for the bank. So they would reward you by giving you better rates. Sometimes. Okay, not too complicated. Rates change every day. So rates today will be different than tomorrow. So again, don't be an expert on rates, because you'll never be an expert on rates. That's why we want to talk to the loan officers to, you know, they can go over and let you know what the rates are, because they change daily, sometimes hourly, if things are volatile. And they can explain to you a little bit about what influences rates, mortgage rates. All right. Conventional loans are pretty fast turnaround times. An average conventional loans, rule of thumb, they can get it done in about a month. So from the day you buy your house, when they get started in the process, until the day they have that check ready for you and all the due diligence that's needed to be done with the lender, they can have that done in about 30 days. So, which is important. Time means everything in real estate, good and bad. So if you have a client that wants to buy a house, and the house that the seller has, they want to sell it fast because every day they keep it, it's expensive, right? You know, quicker the better sometimes. Time is of the essence. Third, cheaper fees. The cost associated with a conventional loan is very reasonable. Banks charge fees to process that loan. That's what pays for their big, huge bank branches and salaries and things. So there's going to be costs associated in processing that loan. Okay. But the fees are very reasonable. Very reasonable. All right. And really the last is they're very flexible on the condition of the property. If you have a house that's a fixer-upper or a handyman special, like we call it in real estate, right? These would be the type of loans that you would be able to obtain to purchase it, as long as it's habitable. Now, if there's no running water, no electricity, that's a totally different situation. But if things need painted and some work needs to be done on the house, these types of loans work very well. They're very forgiving on conditions of properties of homes. Now, some cons is, like we talked about earlier, with the banks, you know, dealing with them going back in the vault and scraping the money out of the safe, so to speak. Some of the cons is larger down payment requirement. So you got to have a pretty decent credit score to get these loans. Okay, what that credit score is, you've got to talk to your loan officer. Okay, those credit scores, I've seen those credit scores go 100-point swings over the last decade. So please don't be an expert on this. This changes all the time. There's underwriting guidelines. Check with your loan officer, and they'll steer them in the right direction. Okay, but larger down payment, meaning they might need to come up with more down payment than an unconventional loan. Now, we talked about 20% down. A lot of people have this myth that to get a conventional loan, you need 20% down. That's not the case. I've seen it everywhere that you could get a conventional loan with all these great pros with as little as 3% down. It depends on how aggressive banks are wanting to lend money. If they are not really interested in lending money, they will make it more difficult for you to obtain a loans. They'll require better credit scores as well as higher amounts of down payment. But you can purchase a home about any time in human history for less than 20% down. Okay. All right. So don't think that all your clients need 20% down to buy a home. That is not the case. There's even loans out now, depending on the time, but of the human history of lending money. But there's been times where you literally, buy a house with zero down, zero, nothing out of your pocket. You're not cutting a check for anything. Okay. So let's talk about unconventional loans. Let's talk about the pros and cons with that. Now, if you look at the screen, you're going to say, well, wait a minute. It seems like a lot more, it's almost flip-flopped. Conventional loans look a lot more enticing. It's subjective. It depends on how you look at it. But again, have them sit with the loan officer. They'll give them different options of what they can do. There's many different types of loan under these umbrellas. We're not going to discuss today. That'll be a whole different chapter. Okay. So in unconventional loans, that is your FHA, your VA, your USDA loans. They also have great rates. Their rates are still very good. They're sometimes just the same as a conventional loan rate. Those do change all the time, so please contact your loan officer for updated rate details. Another pro is you have a very low down payment requirement and a low credit score requirement. So if you have a client that really doesn't have a lot of resources and they don't have a lot of down payment money, this is a great option for them, the unconventional loan. And sometimes that's the only option that we have, and that's fine. That's totally fine. If that's all they can qualify for, but still obtain a loan, let's do it, right? What's wrong with that? So awesome. Now let's talk about some cons. If you notice, there's a lot more cons than there was on a conventional loan. But think of it this way, guys. Anything that the United States government gets their hand in is going to turn out bad. Let's be honest, right? Everything's going to be slower. Everything's going to cost more money at every aspect of the government level. No different on the loan side as well. But a big con is slower turnaround times, and this can really hurt you if you have two people wanting to buy a home. And I've seen it where the conventional loan client has offered less money, but they get they'll beat out an unconventional loan buyer because they can close faster. Remember, a conventional loan typically takes 30 days. An unconventional loan, you're looking at about 45. I've seen it a little faster, but I've definitely seen it a lot longer. So those extra 2 weeks, 2 to 3 weeks, that might be a deal breaker for a seller. Sometimes they don't care about the money. They just want their home sold faster. And they might accept less money than they would than a conventional loan with a higher offer, because they just want the house sold quicker. They just want it off the books and move on to the next adventure, so to speak. Okay. Again, another issue when you deal with the government, higher fees. Because not only do you have the bank handling it, because the same bank that can do a conventional loan can do an unconventional loan as well. Okay, so that's why the loan officer will give them a couple different options of what to choose from. So but when you not only do you have the bank to deal with, now you're dealing with you're dealing with the government department as well to back that loan. So you have two people involved, which means it's slower, and then the government is going to charge you fees on top of that. An unconventional loan is the most expensive loan that you're going to do from a fee standpoint. Now, a lot of those fees, they wrap up into the loan, which means this: if you buy a house for $100,000, and they'll take all those fees that you have to pay, and then they'll stack it in your loan. So if you buy a house for $100,000, you might owe $105,000, for example, for your loan. You actually owe more than what you paid for the house, because they will take all those fees, they'll jam it in the loan, and make you pay it off in 30 years. Okay, it's very expensive. Your loan officer can break that down for you to show you which one is more desirable for you. But if you have a weak credit score, lack of resources for a down payment, then this might be your only option. And it might be fine if you're not paying little to nothing out of your pocket. It's not your money. Who cares? I could own a home with really little to no money out of my own pocket. I think that's a win-win. So God bless, right? So third issue, we talked about fixer-uppers and handyman specials and things. This is where it can be an issue. If you have a client that's looking to purchase a home that is a little rough, and when I say a little rough, I mean just a little rough. It doesn't have to be really rough, but a little rough. I mean, it could be paints, peeling paint, carpets ripped up, garage door needs repaired. When they come out to appraise the property, if there are things that need to be fixed, they will not allow that sale to be processed until those items are repaired. So if you have a client that's looking to purchase a home that is a fixer-upper or a handyman special, these types of loans might not be the right one for them, because the bank will require those things to be repaired before the home is purchased. And the issue is, who's going to pay for those? Does your buyer pay to have repairs done on a house that they don't even own yet? Or does the seller repair these items for the buyer when they're just trying to sell their home? So that's a catch-22 sometimes. It could be a huge issue for sure. And the last issue is on unconventional loans, there's always PMI. Okay, now things can change. They might go away with some of that on if you pay a certain amount of fees up front, they could go away with PMI. Check with your lender. Again, I'm not the expert on that. But PMI is typically always on those types of loans because, again, you're not putting 20% down on those types of loans. So that can be a very expensive loan as well. So you not only, your interest rate might be a little higher, you have PMI, these extra fees. But again, there's pros and cons with all these loan products. Again, when you have a client, before they want to start looking at a house, have them sit down with the loan officer, get them pre-approved. They're going to go through all these different types of loan programs with them to give them the right program. So when you go to find that perfect house for your client, when you present the offer to the seller, you can tell them exactly what type of loan program that you're going to be using. And so that way it'll get the whole process going. And again, whatever the loan officer needs, just do what they ask, because he who holds the gold is king, and that is the bank in this case.